Good day and welcome to the AMG Advanced Metallurgical Third Quarter 2018 Earnings Conference Call. Today's conference is being recorded. At this time, I would like to turn this conference over to Mr. Steve Daniels. Mr. Daniels, you may begin.
Thank you. Welcome to AMG's Third Quarter 2018 Earnings Call. Joining me on this call, Dr. Heinz Schimmelbusch, the Chairman of the Management Board and Chief Executive Officer, Mr. Jackson Dunkel, the Chief Financial Officer, and Mr. Eric Jackson, the Chief Operating Officer. AMG's Third Quarter 2018 Earnings Press Release issued this morning is on AMG's website. Today's call will begin with the review of the Third Quarter 2018 business highlights by Dr. Schimmelbusch. Mr. Dunkel will comment on AMG's financial results, and Mr. Jackson will discuss operations. At the completion of Mr. Jackson's remarks, Dr. Schimmelbusch will comment on strategy and outlook. We will then open the call to take your questions. Before I pass the call to Dr. Schimmelbusch, I would like to comment on forward-looking statements. This conference call could contain forward-looking statements about AMG Advanced Metallurgical Group NV. Forward-looking statements are not historical facts, but may include statements concerning AMG's plans, expectations, projections, objectives, targets, goals, strategies, future events, future revenues or performance, capital expenditures, financing needs, plans and intentions relating to acquisitions, AMG's competitive strengths and weaknesses, plans or goals relating to forecasted production, reserves, financial position, and future operations and development, AMG's business strategy and the trends AMG anticipates in the industry and the political and legal environment in which it operates, and other information that is not historical information. When used in this conference call, the words expects, believes, anticipates, plans, may, will, should, and similar expressions and the negatives thereof are intended to identify forward-looking statements. By their very nature, forward-looking statements involve inherent risks and uncertainties, both general and specific, and risks exist that the predictions, forecasts, projections, and other forward-looking statements will not be achieved. These forward-looking statements speak only as of the date of this conference call. AMG expressly disclaims any obligation or undertaking to release publicly any updates or revisions to any forward-looking statement contained herein to reflect any change in AMG's expectations with regard thereto, or any change in events, conditions, or circumstances on which any forward-looking statement is based. I will now pass the floor to Dr. Schimmelbusch, AMG's Chairman of the Management Board and Chief Executive Officer.
Thank you, Steve. During the third quarter of 2018, AMG generated $328 million of revenue and $59 million of EBITDA. Thanks to strong end market fundamentals and our relentless pursuit of improvements in productivity and efficiency, AMG's EBITDA in the third quarter 2018 is the highest reported quarterly EBITDA in 10 years. AMG Critical Materials generated EBITDA of $52 million during the third quarter of 2018, an increase of 122% from $24 million in the third quarter of 2017, thanks to increased vanadium prices and strong financial performance in chrome, metal, and aluminum products. AMG Engineering achieved EBITDA of $7 million during the third quarter of 2018, an increase of 69% from the third quarter of 2017, driven by higher profitability generated from the delivery of turbine blade coating furnaces and increased after-sales services during the quarter. On a year-to-date basis, AMG Engineering signed $248 million of new orders in 2018, representing a 1.32 time book-to-bill ratio. Order backlog was $251 million as of September 30, 2018, an increase of 21% from December 31, 2017. I would now like to pass the floor to Jackson Dunkel, AMG's Chief Financial Officer. Jackson.
Thank you, Heinz. AMG's financial performance in the third quarter was very strong, with revenue, profitability, and return on capital employed all increasing substantially versus the same period in the prior year. Revenue for the quarter grew by 27% to $328 million. thanks to a 29% increase in revenue in critical materials and a 19% increase in our engineering segment. EBITDA more than doubled in Q3 2018 to $59 million from $28 million in Q3 last year due to a robust financial performance in both Amg Critical Materials and increased profitability in Amg Engineering. Q3 net income attributable to shareholders increased to $30 million compared to $14 million in the prior year, and fully diluted earnings per share mirrored that increase to 93 cents per share from 44 cents per share in the prior year. Amg Critical Materials incurred a non-recurring, non-cash asset impairment expense of $4.1 million in the third quarter due to the early termination of a customer contract. AMG is in negotiations with the customer in question to fully recover the impairment costs incurred and expects these negotiations to be finalized in the fourth quarter of 2018. Cash from operating activities in the quarter increased by $6 million, or 38% compared to the same period last year. This was primarily due to improved profitability in both AMG Critical Materials and AMG Engineering. AMG ended the quarter with net debt of $32 million, an increase of $22 million from December 31st, 2017, due to the higher levels of capital expenditures incurred in Brazil in relation to our lithium project, as well as higher working capital requirements driven by higher raw material pricing and revenues. Turning now to a review of our two segments, let's start with AMG Critical Materials. Q3 2018 revenues increased by 29% to $262 million, and gross profit increased by $25 million, or 67% versus the prior year. This improvement was partly driven by improved prices, as well as improved production levels and product mix optimization. However, this improvement was partially offset by lower gross profit in silicon metal, primarily driven by a one-time accrual for the repayment of a subsidy granted by the German government in 2012 and 2013, as well as additional furnace maintenance during the quarter. Critical Materials SG&A expenses in Q3 2018 increased by $1.6 million, or 8% compared to the same period in the prior year, due to foreign exchange effects related to strengthening of the euro relative to the U.S. dollar and increased variable compensation expenses associated with higher profitability, as well as an increase in research and development expenses. EBITDA for Critical Materials segment was $52 million, an improvement of 122% over Q3 2017, driven by considerably higher gross profit. Moving on to AMG Engineering, $57 million in new orders were signed up in Q3 2018, representing a 0.86 times book-to-bill ratio. Engineering received new orders for turbine blade coating furnaces, powder metallurgy furnaces, and induction furnaces for the aerospace market. Order backlog was $251 million as of September 30th, 2018, an increase of 21% from December 31st, 2017. AMG Engineering revenue increased $10.5 million to $66 million, or 19% compared to prior year, due to higher revenue generated from the delivery of turbine blade coating furnaces and higher after-sales service revenues. Gross profit increased by $3.5 million, or 24%, to $18.1 million, and gross margin increased slightly to 27% from 26% in Q3 2017, both driven by higher revenues generated during the quarter. SG&A expenses increased slightly by $0.2 million, from $12.6 million in the third quarter of 2017 to $12.8 million in the third quarter of 2018. EBITDA increased by $2.8 million to $7 million in the third quarter due to higher profitability generated from the delivery of vacuum furnaces during the quarter. AMG's SG&A costs overall in the quarter were $35.6 million, or 5% higher than the prior year, primarily due to foreign exchange effects related to the strengthening of the euro relative to the U.S. dollar, as well as increased variable compensation expenses and an increase in research and development costs. On finance costs, our third quarter 2018 net finance costs increased to $4.7 million compared to $2.3 million in the third quarter of 2017. The increase was due to higher interest expenses associated with AMG's new long-term credit facility, which has resulted in higher levels of gross debt and a higher interest rate due to the 7-year tenor of our new bank facility. Taxes. AMG recorded an income tax expense of $10 million in Q3 2018 as compared to a tax expense of $1.7 million in the same period of 2017. The Q3 2017 tax expense benefited from a revaluation of AMG's tax balance in Brazil, but the increase in tax expense was also driven by higher levels of profitability and the full recognition of AMG's U.S. operating loss carryforwards in 2017. On a cash tax basis, AMG continues to benefit from those operating losses, primarily in the United States, to offset taxes payable. As a result, AMG paid taxes of $6.3 million in Q3 2018 as compared to tax payments of $3.2 million in Q3 2017. AMG's effective tax rate was 16% in the third quarter versus 21% for the same period in the prior year. Due to the volatility associated with our Brazilian tax assets, we think our cash tax rate is the most meaningful metric. Due to substantially higher levels of profitability in the United States, we expect to fully utilize our U.S. net operating loss carryforwards in 2018. As a result, the cash tax rate will increase from 2019 onwards, and we expect it to be in the region of 25 to 30%. On capital expenditures, in Q3 2018, these decreased to $14 million from $23.2 million in Q3 2017. The largest expansion capital project in the third quarter was AMG's lithium project in Brazil. In terms of liquidity, AMG's balance sheet is exceptionally strong, and we are in full compliance with all debt covenants as of September 30th, 2018. AMG had $519 million of total liquidity as of the end of Q3 2018, following the successful refinancing of AMG's credit facilities during the first quarter. Cash from operating activities increased by $6.3 million, or 38%, quarter over quarter, primarily due to improved profitability in AMG Critical Materials and AMG Engineering. Despite substantial capital expenditures in the quarter, net debt decreased from Q2 to Q3 by $2.5 million, thanks to strong cash flows from operating activities. That concludes my remarks. I would like to now pass the floor to Eric Jackson, AMG's Chief Operating Officer.
Thank you, Jackson. As we noted last quarter, from a market perspective, demand and pricing continues to be strong for many of our key products. Our operational focus, however, continues to be to fundamentally improve our businesses in terms of profitability, operating cash flow, and return on capital, regardless of pricing. AMG Vanadium's profitability once again improved considerably compared to the third quarter of the prior year due to higher vanadium prices. Ferrovanadium index prices have further strengthened in the recent months. Our Ohio facility continues to operate at full capacity and is sold out for 2019. Furthermore, as we press released recently, we've begun contracting our production into 2020. The fundamentals of the vanadium market are exceptionally strong. AMG Superalloys continues to outperform financially versus prior year due to improved product mix and higher chrome metal prices. AMG Superalloys' strategy to focus on sales of higher purity chrome metal products for the energy storage and aerospace market has been very successful, and recent investments made to expand our capacity of these higher margin products continue to have a positive effect on profitability. AMG Superalloys has doubled its production and sales of high purity chrome products in the last 2 years, leading to an improvement in gross margin and gross profit at the Rotherham site. In AMG Tantalum and Niobium, our tantalum concentration plant continues to perform very well, setting a new production record in the quarter, and sales volumes were substantially higher compared to the third quarter of 2017, when production was impacted by ongoing repair work following the fire in early 2017. With respect to AMG's lithium project, our team in Brazil has made good progress in the commissioning of SP1, and as communicated previously, the first shipment of commercial product to AMG's long-term offtake customer was completed in September, with a second shipment currently in progress. The production ramp-up of SB1 is proceeding with the plans under the management of our EPC contractor as we work towards a handover to AMG once certain production milestones are achieved. Elsewhere, AMG Graphite's heat insulation materials sales volumes improved quarter-over-quarter, as did AMG Aluminum's master alloys. AMG Silicon operated below full production capacity during the quarter as we continue to resolve production issues related to graphite electrode quality. We expect to return to full production levels by the end of the year. AMG Engineering, strong demand for our industry-leading vacuum furnace solutions in the first quarter of 2018 has resulted in an increase in our order backlog of 21% compared to the end of 2017. We continue to see strong demand from the aerospace sector for turbine blade coatings, vacuum induction, and powder metallurgy furnaces. And we are successfully progressing a number of new initiatives which we believe will generate substantial revenue and opportunities for AMG moving forward. We are also pleased with the development of our after-sales service programs, which continue to increase quarter-over-quarter. I would now like to pass the floor to Dr. Heinz Schimmelbusch, AMG's Chief Executive Officer.
Thank you, Eric. As demonstrated through our third quarter results, our business portfolio continues to perform well. As noted earlier, AMG's EBITDA in Q3 2018 is in record territory. Furthermore, based on our updated 2018 guidance, AMG's forecast annual EBITDA in 2018 would be the highest in the company's history. In terms of strategic project activities, I'm pleased to confirm that we continue to make substantial progress regarding our lithium and vanadium organic growth projects. With regard to our lithium activities, the engineering work on SB2 is progressing with an emphasis on leveraging the operational experience emerging from SB1. With regards to our downstream lithium strategy, assisted by our new and highly experienced team of lithium chemical experts in Germany, we are pursuing various options for the downstream expansion. This includes negotiations with complementary partners with combinatorial strengths. We expect to communicate further details. With respect to vanadium, as announced in October, the development activities to expand our spent catalyst recycling capacity are progressing well. Having completed the feasibility study to replicate our existing Cambridge, Ohio recycling facility in October, the AMG Management Board has approved the commencement of engineering work for a twin facility with several potential locations within the operational vicinity of AMG's vanadium's existing plant under final consideration. The dynamics of the spent catalyst recycling market, where there is a shortage of capacity and the usage of catalyst materials in refineries is expected to increase substantially in the coming years, combined with the dynamics of the vanadium market, make this a very compelling opportunity for AMG. Once completed, the new recycling facility will more than double AMG's vanadium spent catalyst processing capability. Subject to permitting, construction is expected to commence mid-2019 with a completion date in early 2021. From then on, we expect a material incremental EBITDA contribution from what we internally refer to as Cambridge 2. Again, advancing our 2018 financial guidance based on improving market conditions across AMG's critical materials portfolio, AMG expects full year 2018 EBITDA to exceed $200 million. In 2019, AMG expects to continue its strong financial performance and improve profitability relative to 2018. To remind you, in May 2017 in the AGM, we first gave long-term guidance stipulating that we would reach an EBITDA of 200 million or more in 5 years or less. In the May 2018 AGM, we amended that guidance, stating that we expect to reach the EBITDA target of 200 or more in 2020 or earlier. Given our aforementioned guidance for 2018, we expect to reach that long-term target already in this year, in 2018. We are obviously working on a comprehensive renewal of our long-term guidance, which we are planning to communicate once again in the annual meeting of shareholders in May 19. Operator, we would now like to open the line for questions.
Thank you. At this time, we would like to open the floor for questions. If you would like to ask a question, please press star 1 on your telephone keypad now. Questions will be taken in the order in which they are received. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. Our first question will come from Philip Ngoto.
Hi, good afternoon. This is Philip Ngoto from ABN AMRO. I have 3 questions to start with, if I may. The first 2 are on the lithium plants. So maybe the first one on lithium spodumene. I was wondering if you can give us a bit of a feeling of the ramp-up profile for the first spodumene plant. So what volumes do you expect to produce and ship in Q4? And how should we think of the volumes going to 2019? At what level do you expect to be, or what level do you expect to produce in 2019 versus the nameplate capacity of 90,000 tons? And my second question on lithium is relating to the downstream plant. So you have taken a bit longer to make a final decision. Initially, you were looking to announce something by the end of September. I assume that's also because of the negotiations that you are having with potential partners. I was just wondering if you could take us through the thinking process and why you decided to look more intensely at potentially partnering up, and how the market developments might have played a role in this as well, given how lithium carbonate prices have developed in the last few months. Those are my 2 questions for now, and if I may, I have 1 more question on vanadium.
Eric, you want to do this?
Hi, Philip. This is Eric. On our 90,000 ton SP1, as we call it, we expect to reach 75% capacity utilization by the end of the year. And our financial plans for 2019, we've made the assumption that we will be on a full year basis at 85% capacity.
As regard to strategy in lithium, we know more today about the lithium market than we knew earlier, and about the whole battery and energy storage space. We have built a team of highly experienced experts, industry-leading experts in Germany. We call them internally our PhDs. They help us positioning our strategy, and that is very beneficial. We have concluded that the key element of any business model here is that we have long-term marketing contracts. And that is a risk-reducing exercise, and secondly, this is further emphasized through partnerships with industry-leading participants or industry participants. In vanadium, in our big project in vanadium, the critical element is long-term supply contracts. In lithium, as we are long to start with, as regard to primary materials, actually it's secondary materials because we mine from a tailings pond, at least initially or the first years. In lithium, as we are long, the key risk-reducing element for us is having no marketing risk when we are doing large-scale investments. We have been in the natural resources industry for a long time. Long-term marketing risk control is a critical element in this industry.
Okay, very clear. Thanks for that, very helpful. Maybe my last question then, just on vanadium. I was wondering if you, I know it's early days, but I was wondering if you could maybe give us a bit of a feeling of the potential order of magnitude in terms of capex for Cambridge 2 plant. And also in relation to that, you have ample liquidity given the new facilities you took on this year. So can you also confirm that you will likely be able to finance it all from the current facilities and the cash generated from the business?
As vanadium is going through a very disciplined build-up of feasibility studies, which we internally refer to as FEL 1, 2, 3, 4. We have completed 2. We are in the next phase of these feasibility studies. We really don't want to comment on the details of CapEx. But let me tell you one thing. The attractiveness of this very large project is amazing. You are thinking about, in terms of acquisition terminology, you're thinking about a cash out normalized annual EBITDA increment of 3. So about 3. And the profitability of this exercise is very, very substantial. So basically, we are talking here about a structural change in the vanadium market, and it has to do with a very, very substantial reduction of the inventory. The inventory in vanadium, by the way, is on ships. There is no inventory in a sense of a LME storage or so. It's on ships. And the inventory has decreased. There's a scarcity, and that is a consequence of structural factors, one of which, as we all know, is the rebar legislation in China to catch up to Western standards, and that has a long way to go. And next, the supply has decreased in a certain way vis-à-vis previous periods because of the ruling that waste imports in China are not possible anymore. Therefore, the vanadium waste containing shipments to China, which were turned into vanadium in previous times, that line is cut. And there are many other factors structurally in nature which affect the vanadium price as a big change, including the vanadium in battery storage. For stationary batteries, vanadium is a very competitive material, and there are big initiatives in this regard which are now affecting the vanadium market, if that is an answer.
Yeah. Okay. Okay. Thank you very much for that. Those are my questions for now.
Thank you. Our next question will come from Frank Clausen.
Yes, good morning or good afternoon. A question related to that, I would say, to the vanadium price. How sustainable do you think the current rally is, and do you already see parties coming up with new supply, like your plants, I would say? So is there already additional supply coming on the market? And then secondly, I noticed that your inventories went up quite significantly, another 40 million this quarter. Is that also related to vanadium, or is there anything else playing a role in that? Thank you.
You want to do the inventory first, Jackson?
Yeah, Frank, it's Jackson. The inventory increase is primarily due to vanadium, but also we've had significant price increases across our entire portfolio. So it's not simply vanadium. And it's worth noting that we've also had higher volumes across much of our portfolio as well, which has led to increased inventory. So it's not just vanadium, although that is the primary reason.
Sorry to come back to that. So this working capital investment that's here to stay. There's no big release anticipated on working capital.
We wouldn't expect it, although I will say that in the fourth quarter, we typically do get a lot of payments and a certain amount of slowdown in our business, which tends to release a little bit of working capital. That is a seasonal effect, however. So you should see good.
As regard to the vanadium mechanics, presently everything is running at full capacity, and that's the normal thing. But everything is running on full capacity, so the supply question can be said that there is no further supply in the short term visible here, and any supply such as from secondary sources takes years. And we do know that, and we are I think the key player in this space. Now you could say, is there substitution? To a certain degree, there is substitution, but that has, I think, always. You can, for certain steels, you can use niobium to replace vanadium, but that is a very limited exercise, and I think has run its course already. So we believe, but the future is of course uncertain, and the future is very difficult to predict, and nobody, is without errors. But we see a very strong market for a long time. It reminds me of a time where the molybdenum price went from $3 to $33 per pound, and then stayed for 5 years above 30. That reminds me of our situation.
Okay, thank you. Thank you very much.
Thank you. Our next question will come from Hank Bierman.
Hi, good afternoon, team. My questions are on lithium, on your guidance, and on engineering. So the first question on lithium, a bit of a follow-up following Philip's question, but basically you're delaying the announcement. I think, like, looking at your comments there, we can safely assume that there's a partnership, sort of, that is the main scenario, and I can also assume, if I may do so, that the delayment predominantly relates to the volatility in the pricing. But what makes you so sure that you now say, okay, we will update the markets in the short term? Because if I remember correctly in August, you said you would update the market in September, which is also quite a small time frame. What makes you so certain that today you can say that you will update us in the short term? Thank you.
I didn't say that I'm certain. And negotiations of this nature are very difficult to predict as regards to. We can't schedule things. That would be counterproductive. And we are in various partnership negotiations with very friendly parties where the complementarity is obvious for both sides. And that's what I'm talking about. And as I said, we are talking about very long-term contracts as part of this structure in order to control the marketing risk. Given the volatility of the lithium market, that is appropriate as a risk-reducing mechanism. So whether such negotiations take a month or more time is completely irrelevant.
Okay, thanks for that. And my second part of my questions relates to your 2019 guidance on profitability. I just want to break that down a little bit. So firstly, when I look at engineering, I see that your order intake has actually slowed down a bit. I mean, historically, the order intake has been quite volatile. But just given all the let's say all the profit warnings and the slowdown of many sort of capital goods businesses here and automotive businesses, so what is currently the market outlook into 2019 in your engineering business, especially given that your backlog still equals 250 million, which represents a 40% increase year on year, where sales is actually flat year on year. So is this backlog, this 250 million, is this due for 2019? And hence, in your outlook, is engineering part of your confidence that you will increase profitability into next year? What can we expect?
You can expect higher EBITDA in engineering in 2019.
Okay, so no market.
We are relatively confident with that statement. The good thing about the engineering business is the accuracy of planning is high vis-a-vis the more volatile commodity cycles. We have in our planning a significantly higher EBITDA in 2019 versus 2018.
So on that question, so we can safely assume that the 250 million in engineering, the backlog, is that due for 2019, and so hence you already sort of have in the pipeline 250 million of sales.
We, as you know, are very conservative in our predictions. So when I say that we will have higher EBITDA, significantly higher EBITDA in 19 versus 18 in engineering, then this has various elements behind it. Element number one is the backlog. The backlog, of course, is only partly the 2019. There are new orders in the coming, which is the second element, very important. The working down of backlogs in the engineering business is, of course, the majority is in the next year, meaning 19, the majority. But there are also long-term contracts. And then there are elements, thirdly, which are not at all in the backlog, which is the own and operate business. As you know, we are having a very substantial business where we operate furnaces for our customers, where we own the furnace and the customers, and we service the customers under long-term contracts. This is a business which is essential to our strategy because it is stabilizing the whole structure. And this is growing. this portion, the so-called service portion. And the service in our case is not the so-called service to service the machines once delivered. It is the operating of vacuum technology equipment on behalf of customers, so to speak, because the customer prefers, in this case, to let us operate and own and run the machines, service the machines, instead of doing it in-house and delivering the things to us in order to redeliver once treated. And that is a very important business. So backlog, visibility of new order inflow, and service business. And all three elements are pretty visible, because the interesting part about this business also is that it is not, you can see orders coming, because the negotiations of such orders is taking a long time, and we can do this in a very accurate way. Summary, we are happy, we are pleased to say that EBITDA in 2019 will be significantly higher in the engineering business than this year. I never have given such a long answer, I think.
Okay, thanks for that. And I think my sort of that question that sort of wraps it together is again on your guidance into 2019. If I sort of do the calculations on the moving part, and I assume engineering is a bit higher, and then obviously you have from spodumene, you have quite a nice sort of EBITDA inflow. But nevertheless, I mean, I think the gearing in your vanadium business is quite high, and I think it will sort of flatten a bit into 2019 as the split fee with the catalyst suppliers is moving up a little bit. So to put it simply, I think your base price for vanadium into 2019 must be quite high in order for you to be quite outspoken on the ramp up in EBITDA into 2019. Is that correct?
That's not correct.
So,
look, obviously the vanadium price went up, so the average price for 2018 is way below the spot price, way below the spot price. And we are very conservative. By the way, in 16, we said we would increase profitability in 17, and we did. In 17, we said we would increase profitability in 18, and we did. And so we did, by the way, by 60%. So our EBITDA development is, if you recall, is 101, 125. Now guidance on 200. And then we say again, like we always say, when we have reasons to do so, we say it is the profitability will increase. And that's all we say.
Okay, thanks guys. That's it for today.
Thank you. Our next question will come from Sam Demeester.
Yes, good afternoon. I have a follow-up question on vanadium, on expansion. You typically mention a payback time of 2 to 4 years for organic growth investments. Do you need the current price levels of vanadium to reach that payback range, or are there other parameters to be considered for Cambridge 2 versus the economics of the current recycler? That's my first question.
That's actually a good question, because it was debated yesterday in our supervisory board in extenso. The profitability of this exercise is very stable. We have, of course, very detailed calculations on the sensitivities involved in this. We are very profitable at $15 per pound. So right now we are at 55 spot. Yes? Does that answer your question?
Yes, but would the payback time of the investment fall within the 2 to 4 year range and the price of $15 per pound?
At 15 it moves a little up. It's like 4.5 times multiple. You know, you can't buy a company for 4.5 times. You might, but it's not a good company. So the profitability of this is substantial. Our base case, we do scenario planning because in investment decisions in a volatile industry, you have to do that. You have to run various cases, and we run these cases in all our units, and then we consolidate those cases, and it's a very, very extensive work behind that. As regards to vanadium, the base case should be between 25 and 35, in my judgment. And we have been in this for 20 years, so we learned a lot about vanadium.
Okay. Thank you very much. Then on the lithium chemicals expansion, would you consider to do both investments, so vanadium and lithium, or are you weighing the one against the other?
Well, somebody said to me, please don't interpret my statement on 25 to 35 as a prediction that the prices go down. We use that in scenario planning as conservative people for the very long term. So we don't see any weakening of prices right now. That's just for clarification. Your second question is a complicated one. We have special financing structures in mind for the vanadium project, which are related to industrial revenue bonds.
Sorry?
You know, in the United States, as you know, there is a special financing option for hazardous waste recycling facilities, which is called industrial revenue bonds. And that is, in this particular case, it is highly likely that this is applicable, which is presently under negotiation. These revenue bonds have a very interesting structure because you get the money for 30 years and at 5% effectively. And that would cover the majority of the capex of vanadium. But your question is too narrow. You say lithium versus vanadium. Both lithium and vanadium have to compete with a variety of other very interesting investment opportunities around us. The reason why we have deleveraged so massively is that we want to be ready to capitalize on these varieties, and we, of course, do, like everybody else, optimization of capital allocation all the time.
Okay. Thank you. A couple of questions more, if I may. So on spodumene pricing, can you share the reference price of the current offtake agreement now that Chinese carbonate prices have pulled back a bit recently?
I'm sorry, we don't.
Okay. But we can assume that it's lower than the sort of spot spodumene price that is going around.
You cannot. You can assume what you want, but it would be not a good assumption.
Okay.
I don't want to, for Christ's sake, I don't want to restrict the freedom of your assumptions. But I would not that if I were you.
Okay, but it is correct that the pricing is linked to the carbonate price. Carbonate prices in China have somewhat pulled back, maybe decoupled a bit from the spodumene price in the market.
Always consider that we also in this context have a floor.
Yeah, true. And then follow up on CapEx. Can you remind me of your 2018 CapEx guidance and why the phasing seems to be loaded towards the fourth quarter? And could you help us out with maybe give some guidance on 2019 CapEx? Although it's early.
Yeah, so on 2018, I think we've been pretty consistent. We'll hit about $75 million.
Okay.
On 2019, we'd expect a similar number that is based on currently approved projects.
That is based on currently approved projects. That's an important statement.
So that is excluding vanadium and lithium chemicals, to be clear. And also the 30%.
That is correct.
Is correct.
The 30% expansion in vanadium is then excluded from the
No.
75. It is not.
Excuse me. Let me clarify. We announced a long time ago a 30% expansion of Cambridge 1, so to speak. That has been replaced, given the market conditions, by the decision to duplicate Cambridge 1 and build Cambridge 2, replacing the 30% expansion, because it's much more economic simply to build a new one.
Yes.
And that has also enormous productivity advances. So vanadium is excluded. Vanadium Cambridge 2 is excluded from the CapEx statement Jackson has just given. So is lithium chemicals.
Okay. And then final question, if I may. Lithium carbonate versus hydroxide, if you would pursue with chemicals, has your view on that changed recently?
I'm sorry, Stan, could you repeat that question? Our line broke up there for 1 second. I apologize.
Okay. So a last final question on lithium chemicals, potential lithium chemicals project, hydroxide versus carbonate. Has your view on that changed recently?
I would. we always were thinking about hydroxide a lot.
But the transport remains an issue.
There are certain solutions which cover that subject.
Okay. Okay, these were my questions. Thank you very much. Very helpful.
Thank you. Our next question will come from Krishan Agarwal.
Yeah, thanks a lot for taking my question. Most of them are already answered. A couple of on the vanadium. I mean, the revenues were very strong in the quarter given the spot prices. Can you discuss the margin picture in the business in the quarter and how the margins has evolved so that we can understand the operating leverage in the business? That's my first question.
We are not commenting on margins. That would be not helpful in our markets. So please, that's too detailed a question.
Sure, okay. And then a couple of housekeeping questions following up on Philip's question. So you said 75% capacity utilization by end of 2018 in the spodumene 1. So does it mean that you will have sort of 15,000 tons of shipments booked in the P&L, or that is going to be a different number, just to help us on modeling stuff?
Yeah,
I repeat what you said.
Yeah, I don't want to go into detail on what the revenue recognition will be. You know, it's CIF China is our sales. So I just want to talk about the production levels, which you just.
Understood. Thanks a lot. And yeah, I'm done.
Thank you. Again, as a reminder, if you would like to ask a question, you may press *1 on your telephone keypads now. Our next question will come from Philip Ngoto. Philip, your line is open.
Apology, I had it on mute. I have one last question, and that's actually related to both the lithium and the vanadium project, the lithium downstream project. I mean, these are both quite large projects, also given the size of the company. I'm just wondering how, whether you have discussed as well internally in the board, whether it's not taking on these two projects simultaneously it's not too much of a it does not have too much impact on the company. I mean, how do you ensure that that you can actually execute these projects, that the execution goes in according to plan? And have you, in that sense, maybe considered on putting one of the projects on hold before actually, or just putting one of the projects on hold? That's my question.
Our scenario planning includes a so-called lead scenario, and the lead scenario, which is summarizing our basic beliefs about the various businesses and includes a variety of projects, including the projects you said, and exact estimates of scheduling and dates and startups and everything, leads to a maximum leverage below 2 times. Actually, in year, I think year 3. So, and way below in year 1 and 2, and in year 4 and 5. So our maximum leverage in that lead scenario, including all the projects which we want to do recently in our capital allocation exercise, is not leading to any stress. And that refers very much to what I said earlier, to the industrial revenue bonds. That includes in the debt these industrial revenue bonds, which are extremely low cost vehicles, and actually then is the majority of our debt. So that's almost equity, industrial. You know, when you have 30-year money at 5%, thank you very much, and no amortization, that's a hybrid between debt and equity, but you count it as debt. And if you exclude that, we are practically not leveraged.
Okay, that I understand from a financial perspective, but I was also wondering from an execution perspective, given the size of the project, do you have sufficient capacity to take on two of these large-scale projects?
That's much more relevant. That's much more relevant. This question is a key question, and actually that's our main concern, which we have to manage. And in case we come to the conclusion that we overdo it, or we are in danger of stressing the management resources, then we delay projects.
Okay. Okay, thank you.
Thank you. Again, ladies and gentlemen, as a quick reminder, you may ask a question by pressing star 1 on your telephone keypads now. Well, speakers, at this time, we have no further questions in the queue.
Yeah. Okay, thank you very much, operator. That concludes the call for today in that case.
Thank you very much. Ladies and gentlemen, at this time, this conference has now concluded. You may disconnect your phone lines and have a great rest of the week. Thank you.